And Joseph, there's so much for investors, for market participants to grapple with, given everything we've seen on the geopolitical and data front. What are you expecting from the Fed next week?
Hey, Maggie. First of all, thanks for inviting me here. I really love Real Vision, and thanks, Dee, for a great discussion. That was super interesting. Before this whole Ukraine thing happening, what the market was thinking about was what would the Fed do? And I think to understand what the Fed would do in the next meeting is to look at the world from the Fed's perspective. What does the Fed care about? Again, full employment and price stability. Now, where are we on those? Full employment has been met. We see employment compensation at multi-year highs. You've had Fed governors come out and tell you that we've met full employment. And so what about inflation? Well, inflation is far, far above the 2% where the Fed would like it, like you mentioned. So from this lens, you can kind of interpret what Ukraine and this Russia saga will impact the Fed. As Dee mentioned, there's a potential here for significant surges in commodity prices. So the Ukraine incident, that is a potential upside risk for inflation, something reminiscent of what we saw in the negative supply shock in oil back in the 70s. So in my view, the thing keeps the Fed on track. I mean, there's no way the Fed is going to, let's say, look at this and become more easy. They're going on track to going to hike probably once every meeting. The more recent take we have from this is from a speech by Governor Waller a couple of days ago. And he was still open to 50 basis points. Now, that's probably not 50 basis points in March. Now, that's probably not the most likely outcome. But if we get a big CPI print in, say, March 10, when the next one comes out, that's on the table. So right now, what's happening in Ukraine hasn't changed the Fed's calculus, in my view.
Yeah, if anything, perhaps put more pressure on them as they try to grapple with inflation. I mean, do you think, we always talk about the Fed having blunt instruments to try to deal with this. Do you think that they are going to be successful in trying to fight inflation? How much of this is an expectation game, and how much do we have to wait? Because there is a lag between what they do and any effect on the economy. How are you thinking about all of that? And will that determine the pace of tightening? Do they need to be more aggressive to sort of show they're getting in front of it?
Yeah, that's a really interesting question. So the Fed raises overnight rates and tightens, and how does that actually feed into the real economy? I don't really think there's a consensus on this. I think most economists have the view that you've just enunciated. Monetary policy acts with a longer variable lag. So if we hike now, maybe sometime in the future, things will slow down. But when Chair Powell was asked about this, he's like, yeah, I don't think that's how it works. In fact, when I hike rates, that's immediately priced into the markets. And he's right. So the Fed, by communicating that the Fed is going to hike maybe multiple times this year, you can already see that priced into the short-term interest rate markets, priced in the two-year Treasury, and priced into the belly. So I think the impact is immediate. But here's the thing, though. It seems like, in my view, the impact of the Fed is much stronger on the financial markets than the real economy. I'm not sure if an extra, let's say, 200 basis points is going to affect on consumer spending or business investment. It doesn't seem like it would make a difference, especially when, let's say, in an inflation environment where businesses are having record profits and employees are having record wage gains. So I think the primary impact would be on the market, and it can be a substantial impact. So the way that I look about this is that the primary mechanism from how the Fed impacts markets is its impact on the debt market. The Fed's, by raising rates, very direct impact on, let's say, short-term to medium-dated treasuries. And then they're promising to do very aggressive QE to make sure the long end goes up as well. And when you're doing that, though, mechanically what happens is you're haircutting everyone's bond portfolios. And if you do that just through rebalancing mechanisms, let's say you're a target date fund, maybe you're just a classical investor with a 60-40 portfolio, maybe let's say you risk parity strategy hedge fund, you're going to have to sell equities to rebalance. So I think that impact is probably the most direct impact, and you see that kind of playing out a little bit heading into this year. And I think we're not done yet.
So this is so important. So you're talking about what we refer to as quantitative tightening, correct?
Right.
The reducing your balance sheet. And we mentioned at the beginning of the program that you are a former Fed trader. You were on the open markets desk, the open markets desk during, if I'm not mistaken, during their last attempt at quantitative tightening. So you really understand the mechanics of this in a way that most of us don't. What do we need? So if I'm hearing you correctly, you're saying that just by the mechanics of how this works, everyone takes a haircut, you have to rebalance, and therefore you're going to have to sell equities. From where we are now, what does that look like? What kind of downside risk does that present?
That's really hard to measure. So basically what's going to happen in the coming months is the Fed is going to try to, what they would say is, increase the term premium of longer dated treasuries. And what we would say is they're trying to make the treasury rate go higher. And there are good reasons for this, right? So if you look at the housing market, we're going up 20-30% a year. That's not socially desirable. That makes housing unaffordable, and there's a risk of financial instability there. So the Fed has announced aggressive quantitative tightening, and you can see the mortgage markets over respond. So in the past couple of months, primary mortgage rates have gone up 1%, so 3% to 4% now. What the Fed is trying to do is increase the supply of duration into the market. Longer dated Treasury rates are largely determined by supply and demand. Fed holds $5.5 trillion in treasuries. It holds $2.5 trillion in mortgage agency MBS. So by trying to get that off its balance sheet, by letting it roll off, potentially selling the agency MBS, you can significantly increase the supply of that into the market and push it higher. Now, the Fed hasn't been clear how, or I guess the rate at this will do it, but they've been leaking out or hinting at very aggressive rates. President Bostic suggesting that it could be at least $100 billion a month. The Fed has this lever here where it's trying to increase term premia, and it has the tools to do it by increasing supply. Now, we won't exactly know how much, but it's going to go higher, and that's going to impact people's portfolios, and that's going to lead to rebalancing into the equity market because all markets are connected.
Yeah. So it sounds like there's a huge amount of risk for equity. It's not a sentiment. You're not making a judgment call just based on the mechanics of how this works. Every road seems to lead back to people having to sell equities. Am I overstating that?
That's how I view this. So the Fed has control over rates. It's telling you it wants rates to go higher. That's just not good for risk assets like equities. If you're a traditional value investor, you would talk about things like dividend discount model or something like that. I don't really believe in stuff like that. I just say mechanically, a whole bunch of people who are holding treasuries and equities are going to have to sell some of their equities to rebalance. And the level of that rebalancing is enormous. People who have these assets, these strategies are in the trillions of dollars. And you have to combine another aspect as well, which is also super important. Market liquidity isn't very good right now.
Yes.
I think what happened is that we have these enormous asset values go up higher because liquidity isn't good, but that reverses as well. An easy way to see this is just what happened to Facebook, say a few weeks ago. Just $1 trillion stock going down 25%. That's just straight up evidence that liquidity is not good. $1 trillion stocks are not supposed to trade like penny stocks.
So when you say there's no liquidity, can we also phrase that it's going to kind of pushed up by this squeeze, by passive investing, by these flows that are going in, but there's no buyers on the downside when something turns? Is that a fair way to describe the liquidity that you're talking about? Like, why is there no liquidity?
I'm not really sure. I think that Mike Green's passive investment theory, which I think you're alluding to, I think that makes a lot of sense to me. And it seems what happens is that the asset values of these stocks, the prices go up much, much faster than the actual market depth. So when people are trying to sell, it's like an auditorium. Auditorium gets bigger, the exits don't really get the same. People can't go out at the same time, so prices kind of fall out. And this is not just about the equity market. This is the treasury market as well. So treasuries, cash treasuries, one day is about $600 billion a day in transactions, $23 trillion to marketable treasuries. Okay, rewind back 20 years ago. Cash treasuries, daily transactions, about 400 billion, just a little bit smaller than what they are today. But back then, marketable treasuries was like 6 trillion. So it's like, 20-30% of what they are now. So you have the same thing happening in all our markets. That makes the potential for volatile moves.
So you saw what happened last time. You were right in the thick of it. They thought the repo market broke. We had this massive move. We had markets not working properly, and the Fed had to stop. Do you feel like, because it wasn't so long ago that you worked there, does the Fed broadly, not just the FOMC, feel like they have a better understanding this time around? Or are they once again sort of operating without a playbook, hoping for the best, and then they'll have to react in real time if things start to break?
In my view, what happens during quantitative tightening is that you reduce the cash balances of banks, you reduce the reserves. Now, the biggest impact on markets is what the banks were using that cash for. During the last quantitative tightening, banks were taking their cash, their reserves, so reserves are cash for banks, and investing it into the repo market. When quantitative tightening was happening, they were taking money out of banks, who in turn were reducing their investments in repo markets because they have less cash. So eventually, the repo market hit an air pocket and it blew up. This time around, banks aren't investing in repo at all. It doesn't make sense. Repo rates are too low. What they've been investing their QE cash in are in treasuries and agency MBS to the tune of trillions of dollars. So if anything breaks this time, it's not going to be repo. It's probably somewhere in the rate space.
This is such an important conversation, Joseph, because these are the sort of I keep going back to the word mechanics, but I think that that's right about what happens when we're in this uncharted territory. And I think what so many people worried about as we stayed here for so long. So I'm going to go back to the issue of so if something breaks, it's in rates, and because of the maneuvers the Fed has to make, we keep going back to the idea of that people are going to have to sell equities. In both of those situations, is there still a Fed put? Will the Fed, what is the pain threshold that the Fed will get nervous, that things are spiraling out of their control? Because a lot of people are saying, listen, the Fed put's dead. They're focused on inflation. They're willing to sacrifice growth. They're willing to sacrifice, pretty big pain in risk assets, in asset markets in order to get control of inflation. You're laying out a scenario that sounds very ominous and problematic, and something that I cannot imagine that the Fed would get behind. So do you think that there will be a backstop if we start to see dislocation in either of those spaces? And do you have any thought about what that would look like?
Yeah, I think that's a really good question, because people do commonly think there's a Fed put, and they're right to think that. But I would actually rewind the clock a little bit, post-GFC, where this whole wealth effect thing began. So post-GFC, we had very low growth and very low inflation. The Fed wanted to help the economy out. What do? They try to blow an asset bubble, Bernanke's wealth effect. Why do they do this? The Fed doesn't have power to spend, but it can have a lot of influence over asset prices. So the thinking is, if people have more assets, well, higher asset prices, they'll feel wealthier. They'll go out, they'll buy, they'll spend, they'll lend. That will help growth. That will help inflation. Let's say you had some Tesla stock, went up 10 times. You feel richer. Maybe you go buy a car. Maybe you buy a house. That stimulates the economy. And that's okay, because growth is slow. Inflation is also low. Rewind to today. What's happening? We have tremendous inflation, asset prices, historic highs. Consumers are wealthier than they've ever been. Now, we know the Fed thinks of wealth as a policy tool. It pumped it up to make inflation go higher, and now it can use it in the reverse wealth effect way. Let's say everyone, slightly less wealth, slightly less money in the economy, that decreases demand. That helps inflation, which is the biggest problem in the Fed's eyes right now. So I actually think I won't say it's intentional, but it's not an undesirable outcome to have lower asset prices. You can think of it as making housing more affordable. You can think of it as reducing demand, or you can think of it as shrinking the amount of wealth inequality in our economy, since it's really, the wealth is held by a very small percentage of people. Now, I don't know if they're intentionally doing this, but I don't think it's an outcome that they're trying to avoid.
Yeah, that's an excellent point. I was thinking redistribution of wealth while you were saying that. However, I think it's all predicated on the fact that it happens orderly. And that's the wild card, isn't it? That's
exactly right. It'll feed on itself. So eventually, I agree. There's a Fed put somewhere. I don't think we're anywhere close to it.